Good morning, everyone. Thank you for joining us today for the Understanding the One-Time IDR Adjustment webinar. Let me start with some housekeeping items. Throughout the entire webinar, your video, microphone, and chat feature will be turned off. This event is being recorded and will be available to you on DFPI's YouTube channel within the next few days. My name is Selena Damian, and I am the Student Loan Servicing Ombudsperson with the DFPI. Part of my work as a Student Loan Ombudsperson is to conduct education and outreach to help Californians with student loans. Now, more than ever, it is important that everyone is informed and prepared to start payments in October. It is my pleasure to be here today with Betsy Mayotte, who is the president and founder of the Institute of Student Loan Advisors, or TISLA. She has been working in the student loan industry for over 20 years and has helped thousands of borrowers with their student loans. This is the first in a series of student loan webinars with DFPI and TISLA. So please subscribe to our DFPI newsletter to get information on future webinar dates and topics. Before I hand it over to Betsy, I'd like to go over today's agenda, tell you a little bit about DFPI and about the Student Borrower Bill of Rights. So today we will be going over, you will be getting an overview of income-driven repayment plans, plan specifics, an overview of the one-time IDR adjustment, adjustment specifics, and the connection to PSLF and consolidation options. Next, please. So a little bit about DFPI. We are the Department of Financial Protection and Innovation. We are California's consumer protection agency. We regulate companies of financial products to ensure they are in compliance, and this includes student loan servicers. So the servicers are the companies that are the borrower's main point of contact. Your servicer is the company that sends your bill, the ones who provide customer service when you call and ask about repayment options. So they are the borrower's main point of contact. DFPI accepts and evaluates consumer complaints, and you can submit a complaint to us directly. We take enforcement and legal actions when these companies are not in compliance. We conduct education and outreach to enhance consumer awareness and protect consumers from fraud and abuse. Next, please. About TISLA. TISLA is a nonprofit agency that provides free, expert, unbiased student loan advice and dispute resolution to all consumers. They work nationwide and are nationally recognized student loan experts. This is their website, freestudentloanadvice.org. Next, please. And then a little bit about an important law and important rights for California borrowers. So it is the California Student Borrower Bill of Rights, or Assembly Bill 376. It became enacted in 2021, and this law applies to student loan servicers doing business in California, including state licensed servicers, as well as banks doing servicing. In California, this law applies to borrowers with both federal and private loans, which is different than the federal rights afforded to borrowers. California is only one of 13 states that has this established advanced legislation to strengthen the oversight of servicers and to protect borrowers. So what it does, it prohibits servicers from engaging in abusive, unfair, and deceptive practices. It requires that servicers provide accurate information about repayment options, income-based repayment plans, and federal forgiveness plans. And now more than ever, when you will be contacting your servicers to obtain information about your options, trying to change your IDR plans, trying to get information on forgiveness plans, it's very important that you understand these rights as a borrower. It requires that servicers respond to a borrower's qualified written request within 30 business days. Therefore, if you contact your servicer and you request your account history or any type of other information regarding your account, they must provide it to you. It establishes special protections for military borrowers, borrowers working in public service, older borrowers, and those with disabilities. Next, please. And just questions, a little bit about questions. Your questions can be posted in the Q&A panel on your screen. You do not ask any specific questions until that topic is covered. And then because there are other participants in the webinar, please do not ask any detailed or personal questions. You can email us afterwards with any specific questions. So now I will hand it over to Betsy Mayotte to get started.
Thank you, Selena, and thanks for that great introduction. I just want to add that regarding the California Bill of Rights, it's, Massachusetts is another one of the states that has a Bill of Rights or additional protections for student loan borrowers. California is definitely one of the strongest. In addition to the state laws, there's also federal protections that exist, and you have rights as a student loan borrower under both federal and state law. We think this is so important, and we want to make sure consumers are informed about this. So, as Selena mentioned, this is actually the first in a series of 5 webinars that we're offering to California residents for free between now and the end of the year. And that is thanks to a very generous grant from the Rose Foundation, for which we're very grateful for, that was specifically provided to provide these free webinars to student loan borrowers in the state of California. One of the webinars we'll be doing, and forgive me, I forget if that's the November one or the December one, will be specifically about the details and understanding your rights as both a federal student loan borrower and a resident of the state of California. So I do encourage you to register for that session, as well as the other sessions that we'll be covering, which are listed on the DFPI website under the events section. We have a link to that at the end of this session. As well as Selena mentioned, I encourage you to sign up for the newsletter to make sure you don't miss the announcement of those other webinars. Going back to questions, with us today, I have my right-handed TISLA. You've got the dream team on this webinar for you today, which is Pat Torkelson. Pat's going to be working the Q&A panel for you. The reason we sort of put these housekeeping rules in place is, especially these days, I know a lot of people come to these webinars and they probably have their own specific questions in mind. Listen, if I'm doing my job right, I'm going to answer that question for you as part of the presentation. So I just ask that people sort of have a little patience. I encourage you to ask questions, but hold off on asking your question until we've covered that section or that topic in the webinar. Because again, if I've done my job right, I'm going to answer that question for you along the way. And again, this is public, it's recorded, the recording is going to be posted. No one needs to know your business. And we just frankly don't have the bandwidth as part of this webinar to answer very specific, detailed, personal questions. So we ask that you keep your questions more to sort of the general topical nature. And if you do need more specific help, you've got TISLA and you've got the folks over at DFPI that are happy to provide free advice for you. So with that said, listen, I'm going to give you a heads up right now. Have your note-taking equipment handy. The topic we're covering today is pretty dense. If I had my way, this would be a 4-hour webinar, and I would have a blast talking about student loans for 4 hours. But for some reason, most people don't like listening to student loans for 4 hours. So that forced me to pack this in to just an hour, and even a little bit less than an hour now that we've gone through all the housekeeping stuff. So I'm going to throw a lot at you. Don't fret. All this information, again, this is recorded, so you can go back and listen to the sound of my melodious voice again if you choose to. If you choose not to, which I would completely understand, we have all this stuff in writing on our website, which is the link has already been given to you, but it's also at the end of this webinar. And also the Department of Education has most of this information on their website, and I provide the links to that as well. So I hope I don't make you feel overwhelmed. I hope I provide clarity. But again, because of the density and the short time, don't worry if you do feel a little bit overwhelmed. We'll get you through it. Okay, so let's talk about the income-driven plans from a general standpoint. The income-driven plans, technically, the first one came into play back in 1994, and that's the plan we call income contingent repayment. The thing is about ICR is that it was very, very rarely used up until fairly recently. And the reason for that is that the only people eligible for the ICR plan are borrowers that have what we call direct loans. Back in 1994 and up until 2010, the vast majority of federal student loan borrowers were not taking out direct loans. They were taking out another type of federal loan that we call the Federal Family Education Loan Program, or the FFEL loans. And even people that did take out direct loans, and when I say just a few, back until about 2010, 80% or more of the federal student loans being taken out were these FFEL loans as opposed to the direct loans. And then even people that did take out direct loans, a lot of them ended up consolidating into the FFEL program. The other reason the ICR plan wasn't used very much was not only because most people didn't have a loan that was eligible for it, but as we'll see as we go through the different plans, ICR actually tends to be, for many people, a more expensive plan from a monthly payment standpoint than some of the other lower payment options that are out there. So the point of this is to explain that even though the first income-driven plan came out in 1994, it practically might as well not have, because of how few people used it. The first somewhat heavily used income-driven plan did not get put into place until 2009. And that was what we call old IBR. And again, we're going to cover the individual plans in a minute. And then most of the rest of them didn't come out until after 2012. The reason that I point that out is because some of the critics, when they talk about the income-driven plans, they say, well, they're fraught with peril. No one's ever gotten forgiveness on them anyway. Well, there's a good reason for that. Not enough time has passed. These forgiveness programs have, these income-driven plans have a forgiveness component baked in, as you'll see, that forgive the loans in either 20 or 25 years. And if you consider that the first really used income-driven plan didn't come into existence until 2009, that it hasn't been 20 years yet. So that's why we haven't seen. I do have one borrower that I've personally experienced that is about to get forgiveness under ICR, but other than that, we won't really start seeing people really start getting forgiveness for a little bit, except for this IDR adjustment, which is of course the whole point of this webinar. So these income-driven plans, they're all exactly the same except where they're different. All of them have a baked-in forgiveness component, which, as I mentioned, is usually after either 20 or 25 years that you're on an income-driven plan. All the base payment is always based on a percentage of your discretionary income, and we're going to define what discretionary income means in a minute. And they all require that you recertify your income on an annual basis. Now, listen, we're in sort of crazy land right now. Thanks to COVID, people haven't been required to recertify their income in over 3.5 years, and aren't going to be required if they were already on an income-driven plan pre-COVID or got on one during COVID. They're not going to be required to recertify for at least 6 months after payments resume in October. It doesn't mean you can't apply for it now, and it doesn't mean you can't recertify your income now if that's what's beneficial to you, but you won't be required to do so until sometime next year. Now, after that, you are going to have to recertify your income on an annual basis. So you need to sort of get it in your head that you're going to have to get back in the habit of doing that. Now, discretionary income under the income-driven plans is defined as your adjusted gross income minus either 100%, 150%, or 225% of the poverty level based on your family size and state. Now, whether it's 100% or 225 depends on which plan you're on, as you'll see in a second. Now, if things weren't confusing enough, we've got the alphabet soup that is the acronyms for all the income-driven plans. And what's even worse is, as you'll see, two of the plans have exactly the same name, but completely different terms. So we have what we call old IBR. That's the one that came into play in 2009. And that's the only one that borrowers with those old Federal Family Education Loan Program loans are eligible for. Then we have new IBR, which is only for direct borrowers with it's only for direct loans. Same with pay as you earn or pay, revised pay as you earn or repay. Now, repay is the payment plan that the recent regulations that just came out on June 30th, they're revising the repay plan and calling it the save plan. Now, repay is not going away, it's just morphing into the save plan. Anybody who's on repay will automatically get transitioned to the rules that are under the save plan. They're not going to get rid. I don't think they're going to get rid of the term repay. I would going, after save has been implemented, I would consider those two names synonyms. But for now, in general, what we're doing is using the term repay if we're talking about the current rules for that plan, and we're using the word save if we're talking about the rules that are about to come into play starting at the end of this month and then next year for the rest of it. And then of course we have ICR, income contingent repayment. Excuse me. That is also only direct loans. It's also the only plan, with the exception of a loophole I'm going to talk about in a second, in a little while, that Parent Plus loans are potentially eligible for as far as the income-driven plans go. And even that, with Parent Plus loans, you do have to consolidate under the direct loan program to get access to ICR. Now, if you utilize this double consolidation loophole that I've mentioned in passing, that will allow Parent Plus loans to potentially gain access to these other income-driven plans that I mentioned, including the SAVE plan. Unfortunately, they are sunsetting or getting rid of that loophole. So if it's something that you need to take advantage of, if you have Parent Plus loans, and it will benefit you to go through the double consolidation to get access to SAVE or pay as you earn, for example, you need to make sure that that process is complete by July of 2025. We have all the detailed information about double consolidation on the consolidation page on our website, which is freestudentloanadvice.org. Now, I'm going to use the acronyms throughout the rest of this presentation. Just as a reminder, if I say IDR, so D as in dog, I'm using the umbrella term for all the plans. If I'm talking about a specific plan, I'm going to use that specific acronym: old IBR, new IBR, repay, save, ICR, etc. Just making sure we're all speaking the same language. All right, so let's talk a little bit more about what discretionary income means for all these repayment plans. For a married borrower who files their taxes as married, the adjusted gross income is the total adjusted gross income for both spouses, and that number you'll get off your most recent tax return. By the way, you always have to submit your most recent proof of income. So they're not looking back 2 years or ahead in any way. You have to use your most recent proof of income. If you're married and you file your taxes as separately, they're only using the AGI for you, the actual borrower. Now, under the repay plan, under the current rules, you are actually required to use both incomes regardless of tax filing status. But under SAVE, which this part of it is effective on July 30th, even under repay/save, they will only use your income. You won't be required to use your spouse's income if you file your taxes as separately. Now, some exceptions to that is if you live in a community property state, your AGI is actually going to be 50% of you and your spouse's AGI. And so that's the number that's used as part of your IDR calculation. As I mentioned, right now there's an exception for repay, but as of July 30th, their repay/save will treat married filing separately as all the other plans do. Now, from a discretionary income perspective, what they do is they take your adjusted gross income and then they subtract a percentage of the poverty level that's based on your family size and state. Now, if you're doing ICR, they're subtracting the actual poverty level. So for example, if you're a single borrower with no children, right now in the 48 states, the poverty level is somewhere around 14,000 and change. So if you are on ICR, they take your AGI and subtract the 14,000 and change. For repay slash save as of July 30th, they're actually taking 225% of that poverty level and subtracting it from your AGI. So again, let's say the poverty level for a single person in the 48 states, it's not exactly 14,500. As I've been saying, it's 14 grand and change, but just to make things easy, let's call it 14,500. So 225% of that is $32,625. So that's what they'd be subtracting from your AGI. If you're using old or new IBR or pay as you earn, or you're on the current repay plan, they're subtracting 150% of the poverty level for your family size and state. So under those plans, they'd be subtracting, for our borrower, for the 14,500, that works out to 21,750 that they would be subtracting from your adjusted gross income. So I'm going to repeat this several times, but I just want to make sure it's super clear, because this is a question that comes up a lot. If you are already on repay, or if you were to apply for it today, and today means July 12th, which is before July 30th, they will automatically convert your payment to the save rules that are effective on July 30th. After July 30th, it might not happen exactly on July 30th, but it'll happen before your first payment is due after the COVID pause, sometime in October. If you're not on repay now, you will have to apply for repay slash save if that's the plan that works best for you. If you're on old IBR, new IBR, ICR, pay as you earn, they're not going to automatically convert that to save. They're only going to automatically convert people that are on the repay plan to save. But again, anybody can apply for repay slash save at any time. So let's look at some examples of how the different plans would shake out for a particular borrower. So in this particular example, we have adjusted gross income of 62,000, a family size of 4, living in the state of Maryland, which falls under the 48 state poverty level. So what you do is you take, now this would be for pay as you earn, current repay, and old and new IBR. You take 150% of the poverty level, which the poverty level so is 26,200. So 150% of that works out to 39,000 and change. You subtract that from the AGI of 62,000, that brings you to 22,700. You divide that by 12 for the number of months in the year. Now, if you were on new IBR, pay as you earn, or repay, you would multiply that by 10%, and that means that your payment amount under those plans would be $189. If you were on old IBR, you would multiply that by 15%, and it means your payment would be $283. Now, for those of you on this call that are math adverse, don't freak out. There's calculators on the Department of Ed's website and on our website and elsewhere that will do these calculations for you. I'm just I think it's always useful to understand the math, which is why we're going through with the math. The other thing is, because none of the calculators that I'm aware of have been accurately updated to reflect the save plan, then some of you that are anxious to know what their payment would be under the save plan are going to have to do the math by hand until that's updated. Now, let's talk about how that would look like for the new save plan. Now, this aspect of save is effective on July 30th. So again, same scenario. We've got an AGI of 62 grand, a family of 4 living in Maryland, 62,000. Now we're subtracting 58,950 from the AGI, because that's 225% of their poverty level of 26.2. So that gives us a difference of a little over $3,000. You divide that by 12, that brings you to $254.16. Now, under the version of save that's going to exist as of July 30th until next July 1st of 2024, they're going to take 10% of that. 10% of 254.16 is $25.41. That's what this person could expect their payment to be, at least until July 1st of 2024. Now, if all they have is now come July 1st of 2024, they're actually changing the percentages under the SAVE plan. If you have all undergraduate loans, they're actually only going to take 5% of your discretionary income. So if this particular borrower only had undergraduate loans, their payment come next July, assuming their income and family size doesn't change, would actually be only $12.70. Now, it is possible under all of these plans to have a $0 payment. And the $0 payment does count towards the forgiveness count that you need for forgiveness under the income-driven plans. And it also counts if you're, pursuing public service loan forgiveness. But that's if your payment calculates out to zero. So let's say this borrower's adjusted gross income was actually 50,000 instead of the 62. In that scenario, they would end up with a $0 payment because you subtract 58,000 from 50,000 and you end up with a negative number. So they would actually give that borrower a $0 payment in that situation, and they would get a bill for $0 every month. Having a $0 payment is different than not being due for a payment and having the payments deferred under a deferment or a forbearance, or maybe you're in school or your grace period. Okay, let's talk about partial financial hardship. Some of the income-driven plans require you to have what we call a partial financial hardship, or PFH, in order to get on the plan in the first place. A PFH exists when the annual amount due on your loans, as calculated under the 10-year regular standard repayment plan, is higher than what your payment would be at 15% of your discretionary income if you're applying for old IBR, or 10% of your discretionary income if you're applying for pay as you earn or new IBR. A partial financial hardship is not required for either ICR or the Repay/Save plans. Now, what that also means is that under the plans where a PFH is required, so again, number one, you can't get on the plan in the first place if you don't have a PFH. So if your income is too high compared to your loan balance, you might not be eligible to get on these plans at all. But again, ICR, Repay/Save don't have that requirement. On the flip side of that coin is that if you're on old or new IBR or pay as you earn, and your income goes up to the point where your payment, where you no longer have a PFH, so now your payment based on your income and family size is the same or higher than what your payment would have been under a 10-year standard plan. In that case, they cap your payment at that amount. You can stay on IBR or pay, and you won't even necessarily need to submit proof of income every year after that. They will just keep you at that 10-year standard repayment plan. With ICR and Repay/Save, there is no cap to the payment. So if your income goes up, you could end up with a payment that's 3 times what your payment would be under the 10-year standard repayment plan. That's not necessarily a bad thing. The name of the game here from a 10,000-foot level, and when it comes to student loans in general, is not forgiveness. The name of the game is paying the least amount over time. And for some borrowers whose income ends up being high compared to your loan balance, paying the loans off aggressively is going to be the way to pay the least amount over time. The other thing for those people that have some anxiety when they hear me say that the payment on ICR and Repay/Save can go above the 10-year standard, you can get off that roller coaster anytime you like. You are not bound to stay in the ICR or Repay/Save plan. So if your payment does get to a point where you can't afford it, you can get off that plan and look into some of the other plans, such as graduated repayment or extended repayment and so on. You might be barred from getting on as you'll see in a minute, you might be barred from getting on pay as you earn or old IBR or new IBR, but there will still be other options available to you. So to go back to the example we were using in the prior slide, in this case, if the borrower had a principal balance of $60,000, their 10-year standard payment amount would be $720, again, under that 10-year standard repayment plan. So if you go back to our example, the IDR plan is calculated out as, depending on the plan, $189, $283, $25, or $12. What those amounts all have in common is they're all less than $720. So that means that our fictitious borrower would be potentially eligible for IBR, new IBR, and pay as you earn, because they will have what we call a partial financial hardship. All right. So what I've just gone over are some of the basics and similarities amongst all the income-driven plans. I'm about to go over each plan individually, and then we're going to actually dive in to the one-time IDR adjustment. Before I do that, Pat, is there any question that you've received that you think might be good for the group?
The one we always get to announce whether they can get copies of the slides.
So a recording of this presentation will be on the DFPI's YouTube channel. We will not be sharing the slides.
But they can get them from viewing it online.
Absolutely. Okay. All right, let's get into the individual plans. So these slides are sort of intended to be a cheat sheet for you. If you go to our website, we have the different plans set up in a grid, so you can sort of do more of a side-by-side comparison. And sometime, hopefully within the next few days, we actually have a more detailed, really wonky, might be a little too much information for some, spreadsheet / grid that really compares all the different plans. Again, that might be a little too much information for some of you, but for those who like to know all the nitty-gritty details, keep an eye out on our website for that spreadsheet / table. Okay, so old IBR. Again, that's the only plan that FFEL loans are eligible for. So, and that's any FFEL Stafford loan, Graduate Plus loan, a consolidation loan that doesn't contain a Parent Plus loan. Again, anytime I say that, I'm not talking about the double consolidation loophole. Double consolidation loophole does make the Parent Plus loans eligible for these plans. Also, direct Stafford loans, Graduate Plus loans, direct consolidation loans that don't contain Parent Plus, again, other than double consolidation. Doesn't matter when the loan was taken out. You can have a FFEL Stafford loan from 1982, and you are still eligible to get on old IBR. They under old IBR, they use 15% of your discretionary income. You are required to have a partial financial hardship to enter the plan in the first place. Now, there is an interest subsidy that is available under old IBR. So if your calculated monthly payment is less than the amount of interest that accrues on your subsidized Stafford loans only, or if you have a consolidation loan, the portion of your consolidation loan that's subsidized, the government's going to forgive the difference in that interest for the first 3 years that you're on any income-driven plan. Now, just to be clear, this particular subsidy, the 100% of unsatisfied interest for the first 3 years on subsidized loans only, that subsidy exists on old IBR, new IBR, pay as you earn, and the current repay. It does not exist under ICR. There's no subsidy for ICR. That 3-year limit is per borrower. So you can't hop repayment plans to get an additional 3 years of this particular subsidy. That's not going to matter so much anymore now that we have Save that has much more generous interest subsidies. But just so you know, the 3 years is per borrower. Once you've used that 3 year, even if you change repayment plans, you don't get that particular subsidy back. Again, that's not as big of a deal anymore because of Save, but there it is. Now, old IBR does have forgiveness after 25 years of being on old IBR or a combination of the income-driven plans. The income-driven plans cross-pollinate as far as the forgiveness count goes. So you can change income-driven plans at any time and not reset your income-driven plan count to 0. So let's say you were on old IBR and you had a direct loan, you were on it for 10 years, you decided to switch to pay as you earn, you would be starting at year 11 towards the 25-year forgiveness. The only exception to that is if you consolidate, and we're going to talk more about consolidation ad nauseum in a minute. So new IBR. New IBR is only for direct loans. It's any direct Stafford Graduate Plus or double consolidated Parent Plus. It's only for borrowers who every single one of the loans that they have were made on or after July 1st, 2014. Now, if you, I mentioned that you can switch IDR plans at any time. That is going to go away. That's true today, but effective July 1st of 2024, if you're on Repay and you've been on Repay for at least 5 years, you cannot then jump on to new IBR. The reason they're doing that is because for graduate loan borrowers, the forgiveness under Repay/Save is 25 years. Under new IBR, it doesn't matter whether you have graduate or undergraduate loans, the forgiveness is at 20 years. So they're trying to avoid people creating a new loophole where maybe Repay/Save is a lower payment for them, but they want the shorter forgiveness time frame. So, which people do that now with Repay and the current pay-as-you-earn plan. But again, the ability to do that is going to be going to a certain point is going to be going away in the future. So effective July 1st, 2024, if you've been on the Repay/Save plan for at least 5 years, you will not be allowed to get on new IBR. New IBR, they use 10% of your discretionary income. You are required to have a PFH or partial financial hardship to get on it in the first place. The interest subsidy is the same as the one for old IBR. It's limited to whatever interest isn't covered by your calculated monthly payment for the first 3 years on the subsidized portion of your loans only. And again, forgiveness is after 20 years. Pay as you earn is very, very similar to new IBR. It's 10% of your discretionary income. You do have to have a PFH. The interest subsidy is the same. The forgiveness is the same. It's 20 years, whether you have undergraduate or graduate loans or consolidated, double consolidated Parent Plus. It's only available to direct loans. The one caveat is that the only people eligible for it are borrowers who have no loans prior to October 1st, 2007. So you have no borrowing history prior to that. Or if you did have loans prior to 10/1/07, they were 100% paid off before you took out any loans after 10/1/07. And then you also had to have received at least one disbursement of a loan on or after 10/1/2011. Now, this plan is being sunsetted. This was part of the new regulations that came out around the Save plan. If you are not actively on Pay As You Earn on July 1st, 2024, you will never be able to get on Pay As You Earn, even if you'd been on it before and gotten off. You have to, the only way you can stay on Pay As You Earn or be on Pay As You Earn is to actually actively be on that plan on July 1st, 2024. So anybody who ends up doing the math and has graduate loans and determines that Pay As You Earn is actually going to be their best long-term strategy, you better make sure you're on it by this before this time next summer. All right, revised Pay As You Earn / Repay. That's another plan that's only available for direct loans. And for Parent Plus loans, you have to have double consolidated them. As I mentioned, they're eliminating the double consolidation loophole as of July 1st, 2025. So if you need to do that to benefit from some of these plans, you need to start that process pretty much right now, but I wouldn't start it. Double consolidation can take some time. And the July 1st, 2025 date is actually the date it has to be completed by. I would not, I wouldn't give yourself less than 6 months to get it all done to be on the safe side. Payment calculation for repay is 10% of your discretionary income, regardless of what kind of loan it is. And that's the way it's going to be until July 1st, 2024, when the sort of the second half of the new SAVE regulations are put into play. As of on or after July 1st, 2024, and again, this should happen automatically for anybody who's already on Repay/Save. And for those that aren't, they can apply for it at any time. They're going to use 5% of your discretionary income if all you have is undergraduate loans. If all you have is graduate loans, they're going to use 10% of your discretionary income. If you have both, they're going to use a proportionate percentage of that discretionary income. And that's the same as if you've consolidated undergraduate and graduate loans together. Although we don't have this direct answer yet because double consolidation is sort of a dirty little secret that the Department of Ed has never publicized. I fully expect that if you have double consolidated Parent Plus, that they will use 10%. But let's say you have $50,000 in undergraduate loans and $50,000 in graduate loans. I would expect them to use, I don't expect them, this is what the math says, they're going to use 7.5% of your discretionary income when they calculate your payment under the Repay/Save plan. But again, that's not effective until July 1st, 2024. Up until then, they're using 10%. Now, the interest subsidy is where it gets really fun. For repay, so the current interest subsidy is just like all the other IDRs, 100% of the difference of the calculated payment and the monthly accrued interest for the first 3 years for the subsidized portion of your loans. But then they do 50% of the difference between your calculated payment and the monthly accrued interest on all your loans for as long as you're on the repayment plan. So as of, up until SAVE came on the block, Repay had the most generous interest subsidies because of that additional 50% interest subsidy on all loans for the entire time you're on Repay. But the SAVE plan is one-upping that. This is really remarkable. Effective July 30th, borrowers can expect on all their loans that 100% of the interest that is not covered by their calculated payment will be forgiven once the borrower makes their payment. Now, let me just be clear about that. So let's say you're accruing $200 in interest a month and your payment under Repay/Save calculates as $100. When you make that $100 payment, they're going to forgive that other $100 in interest. Now, it's based on the payment calculated, not the amount you actually pay. So if you decide to pay extra, that's that extra amount. So let's say, again, you're accruing $200 in interest, your calculated payment's $100, but you decide to send in $200. You're still going to get $100 of interest forgiven. That extra $100, assuming you don't have a bunch of interest sitting out there from the past that has to be satisfied, that additional $100, that extra amount that you would pay would go to your principal balance. Now, for forgiveness, under Repay, if all your loans are undergraduate, forgiveness happens at 20 years. If you even have one loan that's a graduate loan, then the forgiveness happens at 25 years. And that's essentially how it's going to work for SAVE as well. And to answer a question we get often, you have to be on the same IDR plan for all your loans that are eligible for that plan. So you could not do, say, Save/Repay for your undergrad loans and pay as you earn for your graduate loans. You're not allowed to do that. The only way you're allowed to have multiple different plans is if some of your loans aren't eligible for a particular plan. So for example, if you have Parent Plus loans, but you also have Stafford loans that are in your own name, You could do repay/save for your Stafford loans, and then because Parent Plus loans that aren't double consolidated aren't eligible for repay or save, then you could be on a different plan for that. But other than that, you are required to be on the same plan for every repayment plan, for every loan. All right, last but certainly not least is ICR. Now, as I mentioned, ICR is the granddaddy of all the IDR plans and tends to be the least used because in many cases, it can actually be the more expensive of the plans from a monthly payment perspective. I say many cases, that's not always the case. There are some outlier cases where, especially what we see is if the borrower's income is actually a lot higher than their loan balance, ICR could end up being the lowest payment. So don't discount it altogether. So ICR is available to all direct loans, including consolidation loans that contain a Parent Plus. You do not have to double consolidate a Parent Plus to get on ICR. Now, the payment calculation is a little more wonky. It's the lesser of 20% of your discretionary income divided by 12, or what your payment would be under a 12-year standard repayment plan, and then they multiply it by something called an income percentage factor. We don't have the time or the caffeine to explain what an income percentage factor is, so I put a link to the Federal Register that talks about it, and it changes every year. So they announce this is the 2020 announcement of the IPF. You're not required to have a PFH. There's no interest subsidy, but it does have a forgiveness component after 25 years on this plan or a combination of the plan. Now, a couple more things about the payment calculation. It does, they use, if you're filing as married, they're going to use both your incomes. If both spouses are also have loans and you both get on an income driven plan, they'll also take that into account. So essentially what they do in that scenario, so you have spouse A and spouse B, and spouse A owes 100,000 in student loans and spouse B owes 200,000 in student loans. What they do is they take the combined AGI of spouses A and B, and then they take the combined loans, so the total of 300,000 in loans, and they figure out what the base income driven plan payment amount would be. And then they proportionately split it between the two. So in that example, spouse A, who owes 100,000, would, let's say the payment worked out to $300. Spouse A, their payment would be $100 a month, and spouse B's payment would be $200 a month. In many cases, unless there's an extreme difference in loan balances and income, it's almost always going to give you the lowest payment from a household perspective, if both borrowers have loans, to continue to file as married, and for both of you to get on an income-driven plan. That's not always the case, but more often than not, it is the case. The other thing is if you're married and file your taxes as separately, you're losing out on some tax credit and deductions. So even people where both spouses don't have loans, it actually doesn't end up making sense to file separately, even to get the lower student loan payment. We're not tax experts, so please don't ask us to tell you what the difference in your tax liabilities would be. But there are calculators out there on the web that will help you make that determination. Now, if you're on a plan, old IBR, new IBR, pay as you earn, that requires a PFH, and your income goes up to the point where you no longer have a PFH, as long as you don't actively leave the plan and apply for another plan, your payment will cap at what your payment would be under the 10-year standard repayment plan. Again, ICR and Repay/Save have no PFH, so your payment can go as high as your income will dictate it. One other change that came out with the SAVE rules, under all the, and this is something else to take into consideration if you're determining whether to file your taxes as married, filing separately or not. Going forward, if you do file your taxes separate, you can no longer include your spouse in your family size when you're doing the calculation. So that's going to decrease the poverty level that you're going to use, that they're going to use in the calculation. So if you don't have any children or other dependents, you'll go from a family size of 2 to a family size of 1, and so on and so forth. So that's something else to take into consideration. Okay, a few more sort of overarching premises. Under traditional income-driven plan rules, you do have to be on an IDR for the full either 240, which is 20 years, or 300 months for the balance to be forgiven. Payments made under other plans, such as the standard consolidation plan or the graduated repayment plan or the extended repayment plan, they don't count towards the 240/300 months under traditional rules. We're not talking about the adjustment yet. Any payment that's at least as much as you'd pay under the 10-year standard plan will also count towards the 240/300 months. Historically, consolidating would reset your income-driven plan count to 0. Because of the adjustment, that is currently not the case and effective a couple weeks ago, but because of the IDR waiver, practically it's actually not really going to be in effect until January 1st. Consolidation won't reset your count to 0, but will give you the weighted average of the underlying loan income-driven plan counts. So if all your loans are at 50 for their income-driven plan count, and you consolidate after the end of this year, then your count would still be 50. But if half your loans have 50 and half your loans have none, and you consolidate after the end of this year, then it would be a weighted average. So to make things easy on myself, because maths are not my favorite subject either, if you had 100,000 in loans that had a count of 50, and then you had another 100,000 in loans that had a count of 0, and you consolidated them after January, the new consolidation would have a count of 25. If you consolidate before the end of the year, the end of this year, thanks to the one-time IDR adjustment, you will, once they do the adjustment, get the highest count of all your underlying loans as your final count after they do the one-time IDR adjustment. I'm going to talk more about that, and I'm going to repeat it in a bit. Now, you don't have to stay on an IDR plan forever, and you don't have to make consecutive IDR payments. But with the exception of the waiver that we're about to talk about, in order for a payment to count, it does have to be under an income-driven plan. Your employment status and who your employer is not relevant to income-driven plan forgiveness. It doesn't matter who makes the payment. The payment is calculated off of whoever the actual borrower's income is. So there's a lot of scenarios where maybe you have Parent Plus loans and the child is the one who's actually making the payment. That's fine, but the payment's going to be based off of the parent borrower's income. As I mentioned, all of your loans have to be on the same repayment plan, and income-driven plan payments count towards public service loan forgiveness, assuming the borrower is working PSLF eligible employment at the time that they made the payment. All right, finally, I know we're getting close to the end. I hope you guys stick with me. As I mentioned, there is a lot of information here, so I apologize that we're going to run over a little bit. If you can't hang around the extra time, don't forget that this recording will be posted on the DFPI's YouTube channel within the next week or so. Okay, so let's talk about the adjustment. Let's talk about what counts for traditional income-driven plan rules with the new regulations that just came out on June 30th and some that became effective on July 1st. So any payment made under an income-driven plan, even if it's a $0 payment, counts towards the 240/300 payments you need for forgiveness. Effective July 1st of next year, if your loan is in default, you're going to be able to get on essentially a new IBR plan, and those payments will also count towards forgiveness. right now, today, even under the IDR adjustment, no payments made voluntarily or involuntarily while in default will count towards forgiveness. Effective July 1st of this year, in addition to payments made under an income-driven plan, they're also going to count periods of cancer treatment deferment, if you're in a rehab training deferment, an unemployment deferment, an economic hardship deferment, or a military deferment. Effective July 1st of next year, in addition to those deferments, they're also going to count periods that you're in a national service forbearance, a bankruptcy forbearance, as long as you're making the required payments. We're generally talking about Chapter 13 here, and administrative forbearance. In-school deferment does not count here. You'll notice that. Also, grace period doesn't count, and in-school status doesn't count. And there are other periods that are also not going to count, but they are loosening up the rules as to what will count towards forgiveness. Okay, I'm sure you have questions, Pat, but under the consideration of time, I'm going to hold off now to the end to go over them. Let's talk about who's eligible for the one-time IDR adjustment. If your loan was eligible for the COVID pause, it's going to get the adjustment, full stop. So if today you're getting a 0% interest rate, you are going to get the one-time IDR adjustment. Whether it results in any new payment counts for you is a whole different story. But they're going to at least look at your account and apply the rules for the adjustment. To add to it, it's any federally held Stafford loan, Graduate Plus loan, Parent Plus loan, whether the Parent Plus loan is consolidated or not. That includes any FEL loan or Perkins loan or other federal loan that's consolidated into the direct loan program, and that you've done that before December 31st of 2023. So if you have FEL or Perkins and you think the IDR one-time adjustment is going to benefit you, you need to make sure that you submit a consolidation application before the end of this year. Doesn't matter how old the loan is. I have seen open loans from the 70s. If those are now direct loans, they are eligible for this one-time IDR adjustment. You do not have to apply for the adjustment. If you have an eligible loan, which is again any direct loan, they're just going to do it. For many of you, they're not going to do it till 2024, but they are just going to do it. Again, there's no application for it at all. So under this IDR adjustment, here's the premise behind it. If you understand the premise, you'll probably understand most of the rules. They are going to give borrowers credit for any eligible period that they've had, whether or not they were under an income-driven repayment plan, towards the 240/300 payments needed for forgiveness. So let's say you've been in repayment for 15 years, but you've been on a graduated repayment plan, which doesn't count towards IDR. They're going to give you credit for 15 years towards the 20 or 25 you need for forgiveness under an income-driven plan once they do the adjustment. Now, if the adjustment doesn't automatically get you to the 20 or 25 years you need for forgiveness, you 1,000% have to be on an IDR plan once payments resume after COVID to accrue future payments, or be on one of those deferments I mentioned in the last couple slides. You cannot stay on a standard consolidation plan or graduated plan and accrue future IDR payments. This IDR waiver has never been done before. I will bet you a delicious pint of Guinness at the exact right temperature on the perfect afternoon that they will never do this IDR waiver again. So again, if this isn't going to get you to forgiveness, you really need to get on an IDR plan by October. Now, they are also going to count pre-consolidation periods, including periods under the FEL program. It will not apply to periods of default. It does apply to Parent Plus loans. They're going to count it even if the payments were past due or maybe weren't of a high enough amount. They will count any repayment plan other than periods of default. They will count any period you were in an economic hardship or military deferment after 2013. They will count periods of in any deferment other than an in-school deferment prior to 2013. If you've used a lot of forbearance, and they define that as either 12 months in a row or a total of 36 months or more over the life of your loan, they're going to give you credit for those periods of forbearance. They are going to go back to July of 1994. So if you've been in repayment since July of 1994 there and haven't been in default, chances or gone back to school, chances are they're going to count that whole thing, and you're going to end up with forgiveness as soon as they do the adjustment. They are going to count these periods for public service loan forgiveness, assuming that you were working PSLF eligible employment during those particular months. Now, keep in mind, you cannot get credit for PSLF counts prior to October of 07 because the program didn't exist then. But anything that they end up counting as an IDR payment after October 07, where you were working full-time for a PSLF eligible employer, if you submit your proof of employment, they will also count that towards PSLF. We already talked about the consolidation. You do need to apply for consolidation by December 2023 in order for pre-consolidation payments to count. If you consolidate after, they will only give you the weighted average of the underlying loan existing counts. Now, just so people don't freak out, if you consolidate right now, it will reset your count on PSLF and the income-driven plans to 0. But don't freak out. You will get those counts back once they do the adjustment. Now, for borrowers that stand to get forgiveness, either under PSLF or the income-driven plans, as a result of the adjustment, the Department of Education has said that they're going to try to do those sooner rather than later, preferably before payments restart. I don't know if they're going to make that deadline or not, quite frankly. Everybody else is going to have to wait till 2024. Don't know when in 2024. And there is no way to get yourself moved up in the line. A squeaky wheel will get 0 grease in this situation. Filing a complaint with anyone will not get the IDR adjustment processed in your account any faster. People are going to have to put their patience pants on. The Department of Education has a lot of big projects, and unfortunately, Congress has chosen not to give them the funding they asked for to put those projects into place in an expeditious manner. Not the least being 40 million borrowers all coming into repayment all at the same time this fall. So again, people are going to have their patience pants, but they can be assured that they will get the adjustment no later than sometime in 2024. As I mentioned, any payment that's considered an IDR payment under the adjustment will also count for PSLF, assuming you meet the other PSLF requirements. We've already talked about consolidation multiple times. We've talked about the timing. Oh, one thing about the timing. Now, this is something that's been floating around for a while, what's being called the buyback option, or it's also called the hold harmless, that for periods that aren't covered by the IDR adjustment, and this is mostly going to pertain going forward, borrowers are going to have the ability to quote unquote buy back certain periods that would normally be ineligible for the IDR adjustment. The Department of Ed has not put that procedure in place yet. They have issued a little bit of extra information about it that you can find on studentaid.gov. What I can tell you is no matter what, you will never be able to buy back periods that were before you consolidated. And the reason for that is once you consolidate, those underlying loans don't exist anymore. So they can't go back and allow you to make historical back payments on a loan that doesn't exist anymore. So if you have, say, periods of in-school deferment that you feel like you're going to want to be able to buy back, you may want to wait to consolidate if consolidation is going to benefit you. But I'm not even sure if there's going to be time once they do release a hold harmless procedure. I don't know if there's going to be time to do hold harmless and do consolidation by the end of the year. So just something to keep in mind. I also want to make it clear, because I've talked about consolidation so much. Many people, there's no value in consolidating by the end of the year. So I don't want people overly anxious. The only people that need to consolidate by the end of the year are parent plus bars that want to take advantage of a double consolidation loophole and this one-time IDR adjustment, borrowers with FEL or Perkins loans, and borrowers that have federal student loans that have different counts, that have been in repayment for different periods of time. The most common example of that are people that went and got their undergraduate degree, took out loans, took a couple of years off, and then went into grad school and took out graduate loans. That's the most common example. But if you already have all direct loans and they've all been in repayment for the same amount of time, and there's no parent plus loans in there, you do not need to consolidate, and consolidation will not help you in any way, whether it be for save or the one-time IDR adjustment. So thank you for your indulgence about me going over more than a minute on this presentation. I did say that there was a lot of information. If your head's spinning, here's some links where you can find the Department of Ed's version of everything I just said. Also our website and where to go if you have individual questions. I do strongly recommend that you read our website before asking a question as well. I'd like to think that we've put it out there in plain English. Of course, I strongly urge you to subscribe to the DFPI's newsletter to find out about not only other student loan webinars, but other consumer financial related webinars. And of course, their YouTube channel where the recording for this will be. So that's what I had for you today. If you guys are willing to hang out, I'm willing to hang out a little bit longer to ask some of the FAQs that came up along the way. What's your pleasure, Pat? You might be on mute, or you've left me.
So one just came in, and I think maybe this person should just write to us. It's a little confusing to me. So they say they have multiple plus loans that were consolidated into a direct plus consolidation, and then consolidated into a direct consolidation unsubsidized loan. That doesn't make sense to me, Betsy.
Yeah, one of two things happened. Either they consolidated twice and did the double consolidation, or they're just looking at the way it's listed on the Department of Ed or their services website, which it's usually listed as an unsubsidized consolidation loan. So, but the question seems to be, for the IDR account adjustment, are the 36 months of total forbearance counted across these loans, or is it per loan? It's going to be counted for the 36. It's going to be counted across all loans. I will say that for most borrowers, if one loan was in forbearance, they were all in forbearance. But if you do have loans that were in repayment at different periods, they are gonna count it across all loans. So just to make sure that's extra clear, if you had 3 loans and for the year 2014, all 3 of those loans were in forbearance for 12 months, they're going to count that as 12 months of forbearance. They are not going to count that as 36. But if you had a loan that had 12 months of forbearance in 2014, and then you had another loan that was in repayment that year, you'll get credit for 12. So they count each unique month. You can never get credit for more than one IDR or PSLF credit, for that matter, per calendar month.
Betsy, also someone was at a webinar when the IDR waiver was going to be at the end of this year, so you might
Yeah,
want
that goalpost has moved a couple times. They announced, what was it, last April? Was it April, Pat, or May?
yeah,
Or May.
anymore. There's been too many.
Yeah, they announced in April or May that they were going to push it. Most people will be pushed out to 2024. Were there any other questions, Pat, you thought would be good for the whole group?
Hmm.
I know they're all posted.
Yeah, well, the issue of switching from pay to the new save plan, but I think you addressed that pretty well.
Okay.
And
Oh, here's a good question.
oh, the one about grad school.
Yeah. So normally historically with federal student loan regulations, if your loans have been quote unquote, and for want of a better word, tainted by another loan type, you can't untaint it by paying off the loan that's causing the tainting. So, for example, we were talking before about new IBR, how the only people eligible are people whose loans only have loans on or after 7/1/2014. The way that works is, so let's say you took out a loan in 2013, and then all the rest of your loans were after 2014. And then you found out about new IBR. If you went back and paid off the loan from 2013, you still would not be eligible for new IBR because that older loan from 2013, because it existed at the same time of those post 2014 loans, they have cooties. They got each other's cooties. And just because you pay off the 2013 loan, those other loans, those you can't get rid of those cooties. Those cooties are there forever. So they haven't explicitly said how they're going to treat this situation where someone has both undergrad and grad loans. If you pay off the grad loans, will your forgiveness just be based on the 20 years? If I had to guess, I would guess it would be under the same premise that once the loans are tainted, they're always tainted. But that's a good question to watch the Department of Ed's FAQ for. I will definitely pose it to them for clarification.
Thank you, Betsy. That was great information and great questions. Do we have any more?
I don't see any additional questions. I want to thank everybody who attended. I especially want to thank Pat for, as always, being my right hand and doing such a good job answering your questions on the fly. We find that to be really helpful to participants to our webinars. Of course, I want to thank Selena and the rest of the Department of Financial Protection and Innovation for partnering with us on this webinar series and doing the outreach to make sure as many people as possible can benefit from them. And finally, of course, the Rose Foundation. We would not be able to do this series without their generous grant. So we do want to thank them. I encourage and thank you, participants, for coming. I encourage you to tell all your friends and family and hairdresser and your barista, whoever else around you about this webinar series. The more people we can educate, the more people will be able to successfully manage their student loan debt. One of the things we like to say is we think student loans should be a step up, not a setup. And one of the ways to make that happen is through education. So please tell all your friends. And with that, I am going to stop the recording.